He lost $20 billion in a few days. It sounds impossible, yet in March 2021, that's exactly what happened to one of the wealthiest and most secretive investors on Wall Street. His name wasn't Elon Musk. Most people had never even heard of him. Yet behind the scenes, Bill Hwang had quietly built a financial empire so large that when it collapsed, some of the world's biggest banks lost billions alongside him. This is the extraordinary story of ambition, risk, and the hidden bets that shook global finance. Bill Hwang wasn't born into extraordinary wealth. Born in South Korea, he later moved to the United States, where he studied economics and began building a career in finance. He wasn't flashy. He didn't seek media attention. Unlike many billionaire investors, Hwang preferred to stay out of the spotlight. His quiet personality hid an intense competitive drive. Early in his career, he joined TURE Management, one of Wall Street's most respected hedge funds, founded by legendary investor Julian Robertson. There, Hwang developed a reputation as an aggressive investor with strong conviction in his ideas. That reputation would eventually help him build an investment empire, but it would also set the stage for one of the biggest financial collapses in modern history. Long before Archegos made headlines, regulators were already paying attention to Bill Hwang. He launched a hedge fund called TURE Asia Management, investing heavily across Asian markets. The fund generated impressive returns, but success came with scrutiny. U.S. authorities accused TURE Asia of insider trading and manipulating the prices of certain bank stocks. The firm ultimately pleaded guilty to criminal charges, paid substantial penalties, and returned money to investors. Hwang himself settled civil allegations without admitting or denying wrongdoing. For many investors, that might have marked the end of a career. But for Bill Hwang, it was only the beginning of a new chapter. After closing TURE Asia, Hwang created a new firm called Archegos Capital Management. Unlike a hedge fund, Archegos operated as a family office, managing primarily Hwang's own wealth. That distinction mattered. Family offices generally face less public disclosure than hedge funds, allowing Archegos to operate with far less visibility. As global markets surged in 2020, Archegos began placing increasingly large bets on a relatively small group of companies. The strategy looked brilliant. As stock prices climbed, Hwang's fortune grew at an astonishing pace. By early 2021, some estimates valued his personal wealth in the tens of billions of dollars. Yet almost no one outside Wall Street knew his name. But there was something the public couldn't see. Archegos wasn't building its fortune using only its own money. Instead, it relied heavily on borrowed funds from some of the world's largest investment banks. Using complex financial contracts known as total return swaps, Archegos was able to control enormous stock positions while keeping much of its exposure hidden from public view. As long as markets continued rising, the strategy generated spectacular profits. But there was one dangerous flaw. If those same stocks started falling, the entire empire could collapse faster than anyone imagined. And that's exactly what happened. By early 2021, Archegos Capital had become one of the most powerful investors that almost nobody had heard of. Bill Hwang wasn't buying dozens of different companies. Instead, he placed enormous bets on just a handful of stocks, including media and technology companies. That strategy made him incredibly rich as prices continued climbing. But it also made his fortune extremely fragile. Imagine placing almost all of your savings on a few numbers at a roulette table. If they win, you become wealthy. If they lose, everything disappears. That was essentially the position Archegos had created, except the stakes weren't thousands of dollars. They were tens of billions. The key to Archegos' explosive growth wasn't just smart investing. It was leverage. Leverage means borrowing money to make much larger investments than your own cash would allow. Several major banks extended financing to Archegos, each believing they understood the risks they were taking. What many of them didn't fully appreciate was that other banks were doing exactly the same thing. Because much of Archegos' exposure was held through complex financial contracts, no single lender had a complete picture of just how massive Bill Hwang's positions had become. Each institution saw only part of the puzzle. No one realized how large the full picture really was. Came March 2021. One of Archegos' largest holdings began to fall after a company announced a major stock offering. A decline like that isn't unusual. Markets rise and fall every day. But for Archegos, even a modest drop created a serious problem. Because so much of its portfolio had been purchased with borrowed money, falling prices quickly reduced the value of the collateral supporting those loans. The banks noticed, and almost immediately the phone calls began. When an investment financed with borrowed money loses value, lenders often issue what's called a margin call. It's a simple demand with enormous consequences. Either deposit more money or your investments will be sold. Banks across Wall Street began asking Archegos for additional collateral. But the numbers involved were staggering. Billions of dollars were needed in an incredibly short time. Archegos couldn't meet those demands. Suddenly, the strategy that had created extraordinary wealth was turning against itself. Once it became clear that Archegos couldn't satisfy the margin calls, banks faced a race against time. Each wanted to sell the shares it held as collateral before prices dropped even further. The result was a wave of massive block sales worth billions of dollars. As more shares hit the market, prices fell faster. Those declines triggered even more selling. Within days, what had been one of Wall Street's most successful investment firms unraveled. Bill Hwang's fortune, estimated in the tens of billions of dollars, was effectively wiped out. But the damage wasn't limited to one man. Some of the world's largest banks were about to discover that they too had lost billions. When the selling finally stopped, the damage was staggering. Bill Hwang had lost more than $20 billion in a matter of days. But he wasn't the only victim. Major banks that had financed Archegos were left with enormous losses after liquidating its positions. Among the hardest hit were Credit Suisse and Nomura, together losing billions of dollars. The collapse shocked Wall Street. How could one private investment firm create such massive losses without anyone realizing the risk? The answer lay in leverage, secrecy, and a financial system where no single bank could see the full picture. As investigators began piecing together what had happened, they examined years of trading records, phone calls, and financial transactions. Federal prosecutors alleged that Archegos had used massive, concentrated positions to influence the prices of certain stocks while concealing the true size of its exposure through complex financial contracts. In 2022, Bill Hwang was charged with securities fraud, wire fraud, racketeering conspiracy, and market manipulation. He denied the allegations, setting the stage for a closely watched federal trial. After weeks of testimony and evidence, a federal jury reached its decision. In July 2024, Bill Hwang was found guilty on multiple criminal counts. For many observers, the verdict marked the end of one of Wall Street's most dramatic financial scandals. Bill Hwang's story isn't just about losing billions. It's about how overconfidence and excessive risk can destroy even the largest fortunes. Today, the Archegos collapse serves as a powerful warning about hidden risk and the dangers of leverage. If you enjoyed this documentary, don't forget to like, subscribe, and let me know which true crime case I should cover next.